And we want to continue the labor market discussion and conversation, check on the roads ahead for the U.S. economy. And for that, we have Gus Faucher joining us now, PNC Financial Services Group Chief Economist. And let me just ask you your initial reaction to the report, Gus, and then anything that sticks out to you.
Yeah, so this is a good report. The Fed wants to see slower job growth. I think they'd prefer to see even slower job growth than this. But certainly we have seen job growth slow over the course of 2022 as the Fed has raised rates, and that should allow the labor market to cool off as we head into 2023.
All right. And then we were just listening to Ines give some of the statistics. When you dig into the report, some of the demographic breakdowns may surprise people, maybe some reversals in trends. What did you pick out?
Well, certainly we saw the labor force participation rate decline. That's bad news from the Fed's perspective. They want to see more people looking for work. Instead, we saw fewer people. And so that means a tight labor market. And so, that makes it more difficult for the Fed, means they may have to raise rates a bit more. On the other hand, we did see a bit softer wage growth, it slowed to 5% year over year, still higher than the Fed would like, but that's moving in the right direction. So what I think is we are seeing a cooling off in the labor market, but it remains too hot from the Fed's perspective, and they're going to need to raise rates more to cool off some of those inflationary pressures we're seeing in the economy right now.
And I've heard some economists calling this report a Goldilocks report. You look at the stock reaction, definitely to the downside, but maybe that's the bad news is good news here, because the Fed doesn't want to see stock prices go up, as some of the, I believe it was Neil Kashkari said definitively over a month ago. What are we to make of this in light of the bad news is good, good news is bad meme that kind of confuses people, especially some of us in the business sometimes?
Yeah, so what we want is job growth that is slowing to a more sustainable pace. So, even over the last 3 months, we've added about 370,000 jobs per month on average. The labor force just simply can't support that. So we need to see much slower job growth that's consistent with underlying growth in the population. We're not there yet. We're moving in the right direction. So, obviously, if we're adding a lot of jobs in the economy, that means more income, that means more consumer spending. But at the same time, it's contributing to high inflation. So what we want is okay news from the job market, not good news, but indications that job growth is slowing and that we are reaching an equilibrium where those wage pressures in the economy are lessening.
And how about the other part of the Fed's mandate, inflation? So we have maximum employment, stable prices interpreted to mean 2% inflation, obviously far above that. But what are you expecting out of some of the readings, and how does that fit into the expectations, everybody waiting with bated breath for that eventual Fed pivot?
Yeah, no, we are starting to see inflation slow. I think it peaked over the summer. Obviously, we've seen a big drop in energy prices, although we'll have to see what happens with the new OPEC production cuts. Wage growth is slowing, so that should help bring down inflation. It's going to be difficult. We probably won't see that 2% inflation until sometime in early 2024, but we are moving in the right direction. I think the Fed wants to see both a slowing in the job market and indications that inflation is moving decisively towards 2% before they stop raising rates. I don't think that'll be sometime until early in 2023. So, if the Fed is going to be looking at the data as they come in, and we need to see that slowing in inflation and slower job growth if the Fed is going to let up.
And you mentioned the energy market before. I'm staring at WTI crude prices at above $91 per barrel. And it was about a week or two ago that it seemed to be about $8 fewer than that. And I'm just wondering, what do the current energy prices say to you? There were people hoping that there would be some mitigation to help out the consumers here, but we had OPEC Plus step in, reduce their outlook, or reduce what they say they're going to pump by 2.1 million barrels per day. They're already in deficit. What are you making of the energy market and its effect on the U.S. economy here?
Yeah, so obviously the OPEC production cuts are not good news for oil prices, for inflation in the United States. That being said, a lot of OPEC members were already below their quotas, and so I don't think we're going to see that 2.1 barrel per day cut. But I think we're going to get less help on inflation from lower energy prices. But I think the other impacts of the Fed rate hikes in terms of a slowing in job growth, a slowing in demand for consumer durables, that type of thing, that will help reduce in those inflationary pressures we're seeing in the economy, even if OPEC keeps production low.
Even if, lots of ifs in this business here. Appreciate your insights on this Jobs Friday. Gus Faucher, PNC Financial Services Group Chief Economist.